This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
I'd be remiss if we didn't have something in here of value to the everyday client that's not a financial advisor.
Yeah.
So why don't we talk a little bit about the current world? And I'm done talking about tariffs. I don't want to talk about tariffs. So
everything I prepared.
Did you? Okay.
For today was tariffs.
Get your own podcast. We're not doing tariffs. What I'd like to talk about is more generic, like how to stay the course when it's not easy to stay the course.
Yeah.
So this will be an evergreen clip that I can pull out next time the market goes down, because it's going to go down again, John. And when it does, the same things that I think we'll talk about right now will still be true.
Yep.
And I'll kick us off by saying what you and I have heard 1,000 times in the last few months is this time's different. So how do you respond to a client that is worried about their money? They saw the market go down. They see their portfolios down a little bit. And they say, John, this time is different.
Yeah, that's a really great question, because in a lot of ways it does feel different. But just because something feels different doesn't mean that you choose different things. The principles of investment management, from my perspective, don't change based on the environment in which you find yourself. There are 3 determinants of asset allocation. What's your time horizon, what's your liquidity need, and what's your risk tolerance? If those things are remaining consistent, then the rest of what's happening outside of that ball of important stuff is noise. And it's not noise in that the dips and the spikes don't matter, because they do, but it's noise in that it's generally a good idea to stay with your asset allocation as long as it's appropriate for you. Now, a lot of people mistake the risk tolerance piece for the market's down now, so my risk tolerance is down now.
Just say that of the 3 pillars that you named, that's the one that becomes an argument. I can't say that my time horizon has changed. I can't say that my liquidity needs have changed. Those 2 would make me a crazy person. But the third one, I could tell you that based on what I'm seeing on TV, my risk tolerance feels different today than it did 6 months ago. And it's not, right?
No, it's not. And I think that part of that is having good conversations when you're investing clients' assets, having good conversations up front about, hey, right now, for the past couple of years, we've had pretty good markets, right? The stock market has largely gone up. We've had some blips, but we've had a pretty good ride so far, or up until the past few months.
Sure.
And so people have I guess, a survivorship bias type of feeling where, oh, it's been good, it'll continue to be good, so I can take as much risk as I want and I won't have any consequences.
Hot hand fallacy.
Yeah, exactly. But then when things are bad, you're questioning everything. You have to make sure that what I try to do is I try to have strong conversations up front and test people's risk tolerance then. And say, hey, let's say that you wake up and it's the financial crisis all over again, and the stock market's down 30%. We anticipate, based on our analysis of your portfolio, that it'll experience 100% of the upside capture and 100% of the downside capture of the S&P 500. How would you feel if you woke up one morning and your portfolio was down 30%, just like the market?
Yeah, and I think another important thing to tie into that, what I've started to do, and it took me a little while in my career to realize this, is if I say you've got $1 million, how would you feel about a 10% market correction, which happens all the time?
Yep.
10% market correction. And they go, okay, yeah, 10%, doesn't sound scary, it's 10%. But if I say you have $1 million, how would you feel if you lost $100,000 because of a market correction?
Right.
Now, because you're using a real dollar amount percentage, you get a different emotion out of people. So I think for younger advisors listening, or for clients thinking about their own portfolio, when you start to put things in terms of that, and it works on the upside or the downside, but downside's more scary.
Yeah.
We're risk adverse, so I like to do that. I cut you off. Keep going.
No, that's a perfect comment, because the more salient that we can make it for people, for our clients, I think the better off we are and they are in circumstances like this. I think that I get very few reach outs from my clients during tumultuous markets, because we communicate very clearly up front that what they'll see if the market goes down. And some of them are saying, oh, I just don't pay attention. And okay, that's a perfectly fine thing to do too. At our meetings, I'll make sure to bring up the performance and make it clear what's happening. But also, it's important to just spend the time up front to make sure that you're risk tolerant, that your asset allocation is appropriate for where you are. And I think that and then it's important for us to remind people, the people who are skittish about it, who do see what's happening and they start to question things, because it's a very natural reaction. When things are going wrong, you look to see what you can control and then try to control it. So I never fault clients for reaching out, but it's important to keep in mind that it's functioning as we expected it to, not as we want it to, but as we expected it to, and to try to stay the course as much as possible so that we're not overcorrecting. Because what can end up happening is, let's say the market's down 10%, client calls me up and says, I just can't take it anymore. I see that my account is down 7%. I just want to go to cash. If we walk down that road a bit, we go to cash. Now, how do we decide when to get back in? Do we, once we have evident proof that the market's going back up, now maybe we've missed 5 or 6% on the upside, and now we have even more ground to make up. So there's a psychological element here too that makes it really challenging, and that's our job when it comes to the investment. That's how I see our function as financial planners in terms of the investment management. Yes, choosing good asset allocation, but also helping clients deal with the emotional side of the investment roller coaster.
Right. I think you hit the nail on the head with that. So that people get the question or the idea of, why do I need a financial advisor? Is your moderate portfolio going to do better than the Fidelity or Schwab or Vanguard moderate allocation?
Right.
And the answer is probably not. Sometimes yes, sometimes no, but not as an overall trend. The value that you offer from an investment management perspective is a lot of taking the emotions out of it.
Yep.
I become the layer between you and the bad decision. You can still make bad decisions, but if you're going to do that, first you need to explain it to me and get me to, I don't have to agree with it. At the end of the day, it's your money. You can do whatever you want. You probably psychologically want to hear your financial advisor say, yes, let's do that. That makes sense. And if your financial advisor says, no, let's stay the course, sitting in cash would be stupid, don't do stupid things.
Right.
Now, hopefully we've stopped you from doing something stupid. And I think that's the value that's not the only value we provide, but specific to investment management, I think that's the biggest value that an advisor can offer a client.
Yeah, I agree. Helping understand the exact risk of a portfolio, and then helping understand when it's appropriate to reconsider the portfolio, and helping clients to realize that it's not just when we're experiencing some market volatility. So shepherding the portfolio in accordance with time horizon and liquidity need, because largely, as much as we think our risk tolerance changes, because like you said, that's the one variable that's not clear. Like, we can't put a number on it, and there are some poor risk tolerance tools that help you to put a number on it.
Yeah,
but right, but
they all suck.
Right, sure. But largely they turn to mashed potatoes when people are feeling the types of things that they're feeling right now with market volatility. So we stick to all of the metrics of what they told us before. And we ask them if those things fundamentally have shifted. If they haven't shifted, then we stay the course. And maybe we make some tweaks within the portfolio itself to take advantage of the particular situation. We can identify opportunities. That's another piece of value that we can add, that investment managers add. But our goal is just to help you get to the end without making terrible decisions. We're all subject to emotion. We all tend to make emotional decisions, but as few large, fantastic decisions that we can make with our money, I think we're better off for it.
Sure.
Yeah.
Yeah, that all makes sense.
I think so.
This podcast has been two guys just agreeing with each other.
Should we argue
about something?
That's why you bring me on.
All right. Yeah.
I'd love to argue with you about something.
What do you want to argue about?
I don't know. You like football and I don't.
Yeah. All right. That's fine. I don't know. Huh. Yeah. All right. Maybe we should end it there.
Oh, yeah. That's a great note to end it on.
Great podcast. Thank you for coming on. And
thank you, Alex.
Thank you for listening. And
of course.
That's it. We're done.
That's it.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.